Perfect. So let's get started. Welcome back to another insightful episode of the JT Capital webcast, dedicated to exploring sort of the world of real estate investing. Today, we have the privilege of hosting a distinguished guest who brings a wealth of knowledge and expertise in the commercial real estate finance space. Joining us is Harrison Drucker, a seasoned professional from Greystone, which is a leading national commercial real estate lending, investment, and advisory firm. In today's discussion, we will sort of jump into a couple of different areas, predominantly the problem that Harrison's kind of seeing from a lending perspective, the opportunity set available to address these problems, the size of the market need to kind of address some of these opportunities, and what all of this actually means for our investors listening today. And this is going to be recorded as well. So, almost 1,200 LPs listening to this, just looking to grow their wealth, some actively, some passively. So very excited to sort of get you on the podcast and gain your valuable perspective and insight into the real estate finance realm. And so let's dive in. So welcome, Harrison. We're
Thanks.
extremely excited to have you on. So, could you just share who you are and what you do with our listeners?
Yeah, 100%. Well, appreciate you guys having me on. Yeah, so I started out working for a family office. We used to kind of on the operations side, kind of along what you guys do. We were buying and selling non-performing notes, take over foreclosures, kind of that weird middle space between local banks with paper they didn't know what to do with, worked them out, and eventually moved on to the origination front at Greystone, where I've been for quite a while. And what I do here, I kind of lead up a team that focuses on direct originations. So we're not a broker. We focus on products we lend directly, which is Fannie Mae, Freddie Mac, and HUD. And we lend on behalf of, the government, and we kind of balance sheet fund those bonds. They get securitization and they're sold off, and we hold the servicing. So it's interesting and a little different than what I think a lot of people are used to, because, it's normally a broker that connects you with another lender and then they move on, but you're kind of involved with me all the way through the life of the loan. So my niche has kind of been, over the past few years, kind of focusing on structuring deals that need a little bit more love, and the basic run-of-the-mill execution doesn't cut it. That's kind of where I sit, and that kind of ends up having an emphasis on the HUD product, as you know.
Yeah. Well, that's that. Thanks so much for that. Let's dive in, because there's so much to talk about, and so much for our investors to kind of learn from sort of this discussion. In terms of current market trends, like what are some of the top, top three or so problems that you are seeing in commercial real estate lending in 2024, and sort of like how do you envision that playing out not only this year but kind of going a little bit forward into 25, 26?
Yeah, I would say it's, I could probably put it into three buckets. I think number one is, interest rates are higher, right? Which objectively just reduces all of the market kind of movement, because you get less proceeds in a debt constrained kind of product type. Banks aren't, available as much liquidity. So you're relying on Fannie and Freddie primarily, and HUD, which has a 125 DSCR. So if you think about it, the same mortgage you got when your NOI was $1 million, right, when rates were 2%, is vastly different than the same mortgage with the same $1 million at a 6% rate. So it's almost like proceeds are getting cut, even if performance at the property level is phenomenal and completely hit projections. It's purely a financing situation. So I would say, lack of capital from the banks, issue with rates being a little bit higher. The big thing is, less proceeds. So people can't refinance, but on the inverse, they can't get enough debt to pay an attractive price for a deal. So there's less movement. I think the biggest issue that, we've been discussing quite a bit offline is, all the pain in the markets for all the deals that were bought from 2020 to 2022, where they have temporary financing and they have essentially a floating rate on an index that was less than 50 basis points, and it's now 5.33%, I think, today. And that's a deal that looked like it was at 3.5% for the term, and now it's 8.5 to 9.5, which obviously no deal really covers at that level.
Yeah, absolutely. And so, a lot of our listeners have been through the ringer here, given that floating rate
Mhm.
all in was around 3% in 21, and then escalated to about 9% at the highs. So that is significant and happened very fast. People are aware of the hikes in insurance and expenses going up. um, from that perspective of that being somewhat in the rear view mirror in terms of a shock, and then it sort of playing out this year and in the next couple of years, what is the adjustment to your lending strategy? How do you sort of look at
Sure.
this going forward and say, okay, this has happened in the past. Now this is how we make money in the future?
Yeah, and I would say you kind of need to act as if this is the new norm. And I think a majority of this industry was so used to send me your financials, let's look at the deal, we'll get you the loan, easy, A, B, C, D, E, F, G, done. It's just not like that anymore. And in a sense, you kind of need to fight and get creative. And what I'm finding the new norm is the people who are winning business and who are actually securing a refinance or buying deals with attractive enough debt have to get really creative, right? And it's a blend of senior, pref, senior, mezz, and in the kind of senior stretch space, you're seeing kind of the prevalence of a lot of structured debt funds, where, as you probably know, you may see some deals getting done, and you're asking yourself, why is someone taking a bridge in this market if they're probably not getting the leverage they need? And a real reason is a lot of people are stepping up and doing senior, mezz, pref, all from the same shop, but three different entities to, let's just say the senior is 6%, the mezz is 10, and then the pref is 15, to an all-in blend of somewhere in the ballpark of 9. But then they get to that leverage point. So there's a lot of interesting stuff going there to get proceeds. But what I'm seeing more in my specific business, because we do perm debt primarily, is really leaning on the HUD product. And what's interesting about that is I don't think it was as popular, and I guess it makes sense because it takes 6 to 8 months to close one, and there's annual audits, and it's a little bit tougher to get one done. It's definitely not the easiest. It's not a 45 to 60 day close like it is with the GSEs, but you can do a lot with it, right? Instead of a 125 DSCR, it utilizes a 1.176. Instead of a 30-year AM, it's a 35-year AM. And I think one of the coolest features of it is there's two ways that you can, in essence, pro forma NOI a bit, which we've spoken about. And what's really interesting is I don't think a lot of people know how to properly utilize that, even popular HUD lenders, because they've never had to, where it's kind of been a necessity, which now it kind of is. So with HUD, not only is the DSCR and the AM better, and the rate is kind of in line, if not better, and that kind of fluctuates, but the ability to say, hey, this property is trending in the right direction and rents are trading out at about $100 delta. Can we forward underwrite that a bit and say, hey, where's this NOI going to be in 6, 8, 12 months? And take that into account, stress test on a 1176 and a 35-year AM, which, as you can imagine, is showing 20 to 25% more proceeds than anything else. And nothing even comes close. So that's where we're seeing a majority of the business these days going, or we're just seeing people extend and buy some time.
Got it. And I'm curious about values too, because values is something, our LPs definitely deeply care about. And sort of the drop in volume has been dramatic, right? In 2021, there was almost 220 billion worth of multifamily transacting, a record year. And then 2022 was another 200 billion year. In 2023, we only saw about 60 billion transact. And so this price gap that everyone talks about from a buyer and seller's perspective is far enough that it's just not transacting as frequently. Does that sort of impact you as a lender? And how is your product, which is HUD, sort of
Sure.
impacted by that?
Sure. So most people don't use HUD as an acquisition because who's going to give you 6 to 8 months to close a deal? But most of what I'm seeing now, and it really has shifted to that point, right? There's just less acquisitions going on, which are primarily Fannie Freddie plus pref in that sense. But if they are taking something like a HUD execution, it's few and far between on the acquisition side because so many deals don't pencil. There's a handful of deals that are worth less than the current debt balance on the bridge loan, just purely based on the fact that cap rates were 3.5 and now they're 5.5. Even if they stayed in line with their NOI. So I would say definitely a slowdown on acquisition financing, and I would say a ramp up in refinances. is
So,
kind of what I'm seeing a balance of.
so for our listeners, like, let's say NOI did stay stable and
Yeah.
that cap rate jumped from 3.5 to 5.5. What is sort of, and I know we know the answer, but just kind of working through the math, like, what is the impact on values there from 2021 all the way to now?
Yeah, I mean, the impact is you had a deal, and like I'm trying to back of the envelope it even right now, right? But you had a deal that essentially, you could have you bought at $28.5 million, let's say, with $1 million NOI, and now it's worth 18. Like that's the difference of 200 basis points. That's insane. That's a wipeout of, I mean, almost $10 million purely on the movement of rates on a deal that's not that large relative to some of the deals that are transacting. So it's it's insane, right? Because it's almost like some deals where you absolutely killed it. Like let's say you brought NOI from 1 million to 1.5, might not be enough, even though you crushed it objectively by all metrics, purely a financing issue. So it's interesting because we're seeing kind of the difference between operational distress and financing distress, and the two very different things.
Yeah, yeah, absolutely. And we just launched our fund 2 weeks ago, and we're exactly looking for these opportunities where, from a business plan perspective, everything is going swimmingly. These operators are, very high quality operators in the market. Their assets have close to 90% plus occupancy, very good locations, but there's a problem with the capital stack and there's a problem with the financing. Um, because overall in commercial real estate and just even within the apartment world, um, there's such a large expanse of opportunities, right? There's distressed where some of these properties have 70% occupancy and they're really coming up the curve, versus some of them are operationally efficient but still are in need of capital given where we are. So what are some of sort of the creative financing solutions for these owner operators? Like, what is the opportunity set? And I know private credit is a big one. That's something we're
Mhm.
looking at. Why aren't they doing capital calls as much as we think they would?
Yeah, I mean, that's a really good point, right? I think I really started on this. I'll say the specific data set of bridge loans. So there's CLOs, right? Which is the collateralized version of the 3+1+1 bridge loans that funded the 200+ billion of business that got done in 21, 22. What's interesting is we started seeing those deals being at a slight cash out if they affected on their business plan, to neutral, to a cash in, to, oh, you need to put in the same amount that you put in originally just to keep the deal. So the cash in was so egregious. Then you ask yourself this question, what how is the equity made up? And there's two camps. There's really mostly two camps, maybe three, right? There's institutional, like a BlackRock, right? There's the groups that have one or two high net worth individuals, right? And then there's the syndicated platform. And it depends how they're syndicated and what kind of blend you are. And there's obviously a million things in between. But if you think about the deal where, a bunch of random checks were raised, and now you have a capital call where you took a mortgage that was $10 million, and now your refinance is coming up and you can only get 5, and the initial equity in the deal was 2.5, you're really going to ask someone to triple their basis, double it up again, put 2x what they already have in, just to keep the deal alive. And then you got to ask yourself, am I willing to buy that deal again at double the basis as it currently stands with the current, themes in the market? And that's a really hard capital call to make, because someone may just say no, even if they have the money to do so, right? And it comes back to the question of good money after bad. And even if people can make the capital call, they normally don't want to. And then you get into the bucket of a lot of the people you guys probably see, on the real deal. And, that's a handful of people where a lot of those people couldn't even come up with it if they wanted to. So you get to this point where the problem isn't even the cash in won't work. The bit, like if you're in enough trouble, the bridge lender will probably extend you. But if you can't even come up with enough money to finance the next leg of your extension, like we were talking about, these bridge loans normally have a 3-year rate cap, right? In 21, they're maturing in, if they're a 2-year, 23, or 24. So if it was done in March of 21, now in 24, you're two strike on SOFR, which is average where most of the rate caps were put so that you capped SOFR. I mean, think about buying a new one then. It may have been 50, 60K then. It's now almost $1 million, depending on the loan balance, if not way more, depending on the loan size. So, because you're effectively buying an in the money call option, right? It's like the stock's 10, you're buying it at 2. Obviously, it's going to be an astronomical price. So the issue is it's not even the cash in, which is a huge amount of money. It's even the smaller chunk that allows you to buy time for lower rates and for NOI to increase. And that's a really interesting area because the check size isn't gigantic and what a lot of people wouldn't call efficient capital, but super opportunistic because it's really kind of a relatively safe place in the capital stack right after the senior debt that a lot of people can't raise.
Yeah, that's what we're seeing. Like we're sort of seeing really high quality operators say we don't want to do the capital call given the situation that we're in. Sometimes they don't mind doing a capital call, but they don't want to do it twice, which is also another interesting sort of business decision to choose not to do it. It's not that they have to or don't have to. It's
Mm-hmm.
really their business decision to ultimately optimize this asset for sale. They have sometimes gone back to their senior lender and said, can we extend? And there is a lot of extensions and workouts and restructurings going on in the market. But ultimately, a faster and most of the time actually a cheaper option is to even look at a pref equity or a mezz debt or like a private credit fund that sort of fits in the middle of the capital stack and sort of is a win-win for the operator, their investors, and then ultimately the private lender in the middle as well.
Yeah, and to even elaborate on the point that you just made, which is a good point that I kind of even left out, but you're right. The awkwardness of going back to the well twice, asking for, a cash in or capital call just to know that you're going to be asked again in 12 months, unless, pigs start flying. Yeah, that's not easy to do. And also the way a lot of syndications are structured is essentially, let's just say you asked for, 100% participation in the capital call for the rate cap, which was $2 million, and 50% agree, and the other 50% don't. It still needs to be purchased, or else that deal goes into default. So what most of these deals are structured as is in the event that there isn't full participation, another equity partner can lend it to the partnership, right? Or they can have some sort of note at a rate relative to where I would say effectively is an incredibly attractive return and probably on par with where a lot of these pref lenders would be. But it's just awkward to lend your own partnership money and become senior to the already investors that you pitched on this investment initially. So what's interesting is, I think, it solves the solution of it's a great return objectively for the pref provider, and it's you're preferred to all of the existing equity. That's A. So super attractive for them and relatively protected depending on like the control rights. B, it's not awkward as saying, hey, I'm just going to give you the money, so you're just going to have to pay me back before. We brought in, call it a mezz lender or a second lien to do it. We got additional financing, right? You don't need to cough up the cash.
How large do you think this problem is? Because we touched on two things. One is the funding gap, which
Mhm.
is sort of when you go to refinance, you are faced with a cash in situation. The second one that we also brought up was a rate cap. And we all know that a lot of rate caps are expiring in the next couple of years. How large do you think, this entire sort of opportunity set is?
I think there's billions of it. I mean, purely on the securitized market, which, by the way, could be half of what's out there, if not less. Because if you think about it, there's the MF1s, the Ready Caps, the Loan Cores of the world. Those are CLOs, right? So those need to be rated and they're put into pools by agencies. But think about Walton Street Capital. Think about some of these other balance sheet lenders. They don't need to report anything, and they have the same exact structure, the same exact problem, but they're just absent from prying eyes. So I don't even know, but to be honest, I think I have about 9 calls a day
Yeah.
where someone's like, I would take this right now. And the only issue is, do you actually want to lend the money to them? because like maybe the deal's slightly underwater, you don't even want to touch that asset. It's almost like you have your pick of the litter because in theory, if this could happen, it would fix a lot of deals and people will take it right now because what they're facing is I can't make payments anymore. My rate cap's coming up and I'm going to be in technical default, or I'm going to have to give the keys back. Oh, you're giving me the option to buy myself 12 to 24 months covering above a 110. Why wouldn't you take that? Even if you're accruing a much wider rate on a tiny sliver of pref, the net effective blend to the deal overall, if you buy time and get out of it, it would have been worth it every time.
Yeah, absolutely. Like CBRE was out with a article the other day saying that the funding gap that exists right now is around 21 billion and is expected to get up to 44 billion in 2026. So
Yeah.
whether it's BlackRock, Blackstone, or much more boutique players like ours, that funding gap is much larger than what we have to even fund. So we sort of are taking the stance that we want to work with great operators. We want to work with great assets, and then also in great locations that we not only look at these from a short-term perspective within our fund, but also one day hopefully get to know the operator and partner with them either on the asset or other deals that they have. And that's that kind of almost expanding effect where we do one deal, but it kind of expands our reach out significantly. And that's why we're just so excited about this opportunity. It's a huge problem in the market. There's a clear need for it, and then the opportunity set is just extremely large. And then in terms of rate caps too, I believe it's something like close to $1 billion, $4 billion a quarter is expiring, and so they need to get that capital somehow to sort of fund this rate cap and ultimately keep their operational cash flow in check. Otherwise, they face the same issue where at today's sort of prices, it would be a negative leverage situation in which their mortgage payment is higher than what they're buying the cap rate at. So yeah, like we're definitely seeing a lot more of these opportunities come out, and sort of trying to look at past situations and see what we can learn from. Like in sort of past market cycles, have you seen sort of a scenario like this play out, and how did it actually play out?
I'll be honest, I think specifically the way this is hitting multi, I haven't seen before. What's really interesting is in a lot of the loan docs, I don't think anyone expected this to happen, or else there wouldn't have been billions of it originated, right? Who would have underwritten a deal to exit at a 3 or 4% rate with any sort of thought that it was going to get to where it was, right? I don't think anyone could have foreseen this. I mean, at the end of the day, a lot of these operators are intelligent people, right? These people are sophisticated. They know what they're doing. They've been doing this for 30, 40 years. And it's the first time they're getting hit with a deal that literally could wipe out your whole portfolio, right? Like there's operators I'm seeing with 10,000 units and they have $180 million loan and it's worth $100 million now, right? And like that alone, if they have to come up with the cash to do it, if they take the loss, what that does, it's very interesting. There's a lot of stuff
Yeah.
going on, and I haven't yet seen anything close.
Yeah, like I mean, what's happening in multi reminds me a lot of what happened to single family in the great financial crisis. Like for multi to be down almost 20% across the board, and some locations down more than others. If you look at it from a buying perspective, this is like if you went back to '08 and told it, or '09 rather, and said, do you want to pick up any single family properties? I would like try to buy as many single family properties as I could possibly get my hands on. And I feel like that's the scenario we're in for multi today. I haven't seen prices like this in over a decade. And the sort of the fundamentals as well, even though there's a lot of supply coming out probably in the next 2 years, the following 2 years are like as much of a dearth of supply as well, just because the developers are facing the same issue that owners are facing today, which is just like developers already had high rates. Now they have like astronomical rates, and so starts are dwindling by the day. And so even in great locations like Dallas, Houston, Tampa, Orlando, and Florida, and so many other markets, you see a lot of supply coming out, but then it sort of gets absorbed, and then you go kind of back to normal, and probably even better because by 2025, 2026, you're also looking at wage growth outpacing rent growth again. So again, like as an asset class, you have a low price that you're paying. Like, if you're doing class A, class B that we typically do, you have extremely high quality tenants that, are working your tech banking jobs and whatnot. And then you're ultimately getting to a point where there's going to be very little supply of these properties. And so again, your international money, your BlackRock, your Blackstones are just going to have to somehow buy these things, at that point. And so, yeah, definitely find that very interesting. What do you sort of see the main differences between, your class A high quality stuff versus your class maybe B or C more value add stuff? Like, is that sort of being kind of divergent in this economy?
Sure, it's kind of a mixed bag, right? So it really depends on the operator. I'm seeing both. And what's interesting is for something like the HUD product, you can forward underwrite some forward projections. So for example, certain markets in the DFW that are still getting like astronomical rent pops. One market in particular, Amarillo, awesome market, right? Still getting huge rent pops, tons of people moving out into that area. And what's interesting is in that space, the value add play, like you spend 10, 15K on a renovation, you could get a $200-$300 pop. The inverse, in Houston, you bought a 1970, 80s vintage deal, you're spending 10, 15K, maybe you're getting a $100 pop, 50, 75. But then you ask yourself, wait a minute, if I just kept the unit classic and did a make ready, paint the wall, that's it, 3 to 5K, I'm getting the same that I'm getting after I spend 10 to 15K. It's not economical. So what you're finding is people who haven't executed a majority of their business plan in the C space, let's call it 60s, 70s deals that weren't super well maintained, that were kind of, the most prevalent thing that was purchased, those are getting beat up really bad, right? Because even if you stopped and halted your plan, your loan was predicated, like your exit, on you completing something that economically isn't viable anymore. So those are in trouble. It's also on the flip side, some of the deals that were bought by an Alliance Residential, a Trammell Crow, the new stuff bought in 2021, 2022, are at 96, 97, 98% occupancy in Houston, Dallas, all over. And those have bridge loans too, where essentially their NOI actually can't grow and it's flat, if not trending down slowly with all the new supply that they're competing with. It's like 2,000 units would come online in one neighborhood. And even at 96, 97%, that NOI isn't even remotely close. Again, and that's less, there's no more value add, just rates are way too high. And they need to come to close with, $5, $10 million. So it's interesting that there's distress on both sides of both A and kind of C. I find the B actually is playing pretty well because it's somewhere in between and they can kind of undercut the A and still make their debt service. So it's interesting. There's like that little place, but I would say there's pros and cons to each. If you finish your business plan on a C, you might be doing really well because your basis was so good. But on the inverse, you may have gone caught kind of 30, 40% the way and have an issue.
Yeah. So one of the things you're just mentioning is sort of like the deals and like how you view them. Like, I think one thing for our listeners and investors that would be very interesting is like, what type of metrics do you look for in a deal, whether it be, occupancy of the area or the asset itself? What are some of like the key metrics that you look at from a lending perspective that we should sort of get better at from an investing perspective?
Yeah, I think two big things. Everyone, all the government agencies are taking property condition really seriously, right? So take care of your property because a lot of people are having things where, the deal looks great on paper and the cash flow is amazing, but your PCNA comes back and you have $3 million of repairs before closing. Like that's nuts. But it's in this age of a lot of fly-by-night people who just weren't taking proper care of their deals. And you saw a lot of those deals kind of go back, were kind of the first ones, because people just, roofs were falling in, pipes were bursting, et cetera, et cetera. So I would say a lot more of a focus on that. We want to understand that the sponsor actually has a hold of their property in the asset management level, which most don't, to be honest, which is really scary, right? Which is like, if you're investing other people's money, you should have a hold on what's going on. But we're taking a really good look at the sponsor, the rest of their portfolio. How do they take care of their deals? How familiar are they, with what's going on? Or did they just third party and they don't even talk to them, right? They're just like, send the check. And I think a big thing too is just, what was the strategy? What was the opportunity? And were they clever about it, right? And like, what I can sell this story for some of this forward-looking NOI when I understand what they're getting done. Hey, there's supply, it's going to be absorbed, we're going to be here. Or we're doing this scope of renovation for the 2 beds, not the ones, because they get this pop. And when someone has kind of that information at their fingertips, we like to do those deals. That's the type of stuff we want to do. Those are the sponsors we want to work with. And it just boils down to just, sophisticated people who actually take ownership of their deals.
Yeah, that makes total sense. And then sort of more from like that sort of like in acquiring the entire property, and even some in private credit funds, we have like almost a 20-page document that we send the sponsor in order to really see what you were just mentioning and their strategy, not only from a historical perspective, but also a going forward basis. We sort of want to see that they want to be in this space for 20, 30 more years. It's a generational wealth thing, rather than, oh, I've been doing this for the last 20 and this is sort of my last hurrah. And, I don't know what happens. Like that's not what we want to see. And so, from a private credit perspective and sort of looking at different opportunities that, we talked about sort of funding the rate cap and financing the funding gap that might exist. What are some of the metrics you'd look for in those type of deals?
Sure. I think in that case, if you want to come into that layer behind the senior, right? We need to understand the exit, right? Meaning, I know the way you guys think and the way to think is, hey, in 12 to 24 months, if I provide this, call it interest rate cap reserve, or essentially call it capital to buy them time to walk into their extensions or what have you, how do I know that I'm going to get refinanced out? And how do I know NOI is going to change materially, right? Because the business rates coming down isn't a business plan, contrary to popular belief and the fact that everyone likes to say that. It's not. So you need to assume that rates are going to stay the same, if not potentially be a little bit higher. And you focus on what you can control, which is NOI. So I think if you're going to make those investments, you need to make sure A, experienced operator, and B, that you understand the business plan and there's enough of an equity cushion. Because, for example, I mean, this is a very likely scenario right now, which is why I think this is so interesting. There's some amazing, 2000 or newer assets where, let's just say, the mortgages, call it $40 million. The asset's worth 70. The sponsorship group already has $30 million of equity into it because they bought it for 80, but now it's worth 70, right? But there's still $20 million of spread between the $70 value today at a readjusted cap rate and the current balance. So there's $20 million of cushion, and they need to come up with a $2.5 million rate cap or interest reserve or pay down, what have you. That's a pretty safe position to be, in the event that they can make the current pay on the deal and that you're okay with that. Because if you have comfortable control rights, you have a buffer. If you add $2.5 million there, of $17.5 million. Even if the worst case scenario, for whatever reason, they don't effectuate their business plan, in which case you take over, operations, A, B, sell the deal, recoup your equity. But there's like 8 different variations of recouping your capital. And I think it's interesting because, if it goes well, you get your awesome return. If it goes bad, you get your return. It's almost like you're cushioned in a way that you're not even cushioned as straight equity, which is why it's really interesting.
Yeah, like, so can we dig into the control rights a little bit and
Sure.
sort of just like what are you seeing on that front for our fund? Just as you mentioned, we look to, if there's an unforeseen something happen, we have the ability to take over asset management of the property.
Yeah.
We also have decisions on major aspects of the business plan. What other control rights are you kind of seeing?
I mean, I think the biggest thing is that in the event of non-payment, the biggest thing is here, this isn't supposed to be, right? We're trying to partner with good operators, right? So you're trying to give them time to effectuate it, get paid off, go on your merry way. In the event of, let's call it two events, non-payment or default, right? Maturity, they can't pay it off, or, they don't make the current pay, whatever that is. Then yeah, at that point, right, you probably have control rights that either, similar to what I think is cool, similar to what a senior mortgage holder would do without having to foreclose, which is the attractive part about it, right? Because you can essentially bring it to market and say, you need to sell this deal because you can't make me whole, because you've essentially violated, the operating agreement, which we have. And our operating agreement says, you know, me and Denver are going into business, and Denver's a passive partner, and he doesn't have decision-making rights unless I don't make his 6% current pay. If I don't pay you for 6 months, I have violated our agreement. Therefore, you have rights and remedies. I mean, it's that simple. And I think because it's structured as equity, it's a little bit more nimble and a little bit more flexible to go after recouping your capital. And what's also interesting is I think in theory, and I don't know exactly how it works on your end, right? But this is different than the conventional model of put all your eggs in one basket and see how it goes. But you're doing a fifth or a tenth of the check size in 18 plus 10, 20, 15 assets, and you're diversifying that whole risk, right? So even if you need to recoup the deal in a little bit more time and 80% of them pay off, it's interesting because you're so diversified in something that already has, I think, effectively more protection than most conventional equity deals.
Yeah, that's how we're looking at it, right? We're focused on the problem and the opportunities. We're sort of like the pain that's going on there. Like the outcome of that for investors is sort of achieving double-digit returns for extremely high-quality assets in a protected position. So for your investors looking to, grow long-term wealth, this is a great opportunity that you were mentioning we haven't seen for a decade, which is
Yeah.
pretty incredible, to kind of get in on this ground floor with having almost like a crystal ball of saying, oh, like did you want to invest in single family in '08? You have that kind of opportunity in multifamily today,
Mm-hmm.
investing in sort of values that we haven't seen in a long time, and with control rights that protect you, and also protect the sponsor. It's a
Yeah.
two-way street. You want to be as flexible with the sponsor as possible so that they can actually create the value that they want to create on this asset. We're not looking to sort of be restrictive to them. We're looking to sort of partner with them on these deals and sort of also share the JT Capital playbook with them as well. Like, and vice versa too. There's a lot to learn from these sponsors as well. They, as you mentioned, they've been doing it a long time, and so that part we're just so excited for. The other aspect for investors is this aspect of diversification. It's not only different assets, but it's different locations, it's different business plans that you're investing in, and you're getting similar returns to investing in equity in multifamily. So, the risk adjusted return, I think, is incredible. And that's why we're just so excited about the opportunity that kind of presents itself. And we're kind of keeping our eyes wide open for deals and, good operators that we're looking to invest in. And so, yeah, like what, how long do you think this opportunity lasts for? Like, what has to happen for this window to close? Is it all dependent on interest rates, or is it maybe banks loosening
I
up their lending standards?
I'll tell you what I think it is, at least from my perspective, and I can talk to multi, I can't talk to some other asset classes as well without as much competence, but I assume it's similar. I don't think the type of paper that these types of floating rate loans at these high leverage points that were written previously in the past 2, 3 years are getting done again like that. So what I'm saying is the opportunity, I think, may have the life of the last extensions of, last year's and the year before's debt. So, if you think about it, most of them are a 3+1+1 or a 3+1+1+1, or is a 5-year deal. It may, if it started in 21, they stopped ending in 22. So assume the last batch of them. I wouldn't be surprised if that means we have till 2027 for all these to kind of fully be fleshed out to their last extension, meaning that would be like the last term of essentially an investment in a deal like this. So I actually think the heyday is going to be the next, I want to call it 12 to 24 months. I think is really prime time because the pain is starting to really come in a real way. And it's seemingly every other day that you're seeing a deal go back. And, it's here and it's only going to get worse because we're kind of at the point now where lenders don't want to modify. They're like, what am I supposed to do? And I think a big problem too is they're like, okay, half my book is worth about the loan balance and half of it's completely underwater. Even though in theory, these are good deals and they just need a little bit of time and I should give them their extension, I don't need to because technically they failed their DSCR test. Should I just force payoffs and drag them to market, even though they get 100% on their equity, but we get all of our principal back at 100 cents on the dollar to feed this side of the book, which is struggling. And it's scary because we're getting into that position where negotiations with lenders went from, okay, we'll work with you. Yeah, okay, we'll do an interest reserve to no. Meaning it's interesting, right? And you need to get in front of it and being able to come up and say, hey, I'll fund the next 12 months of interest reserve today is also a trick that this is kind of allowing people to do to help negotiate with their lenders, which is, hey, we'll fund it for the next year. We'll be current on our payments. We'll pay it up right now, which is why this is specifically interesting because it's kind of a negotiating token they could start working with.
Yeah, that's fantastic, and I've definitely heard a couple of groups actually taking that route. That definitely makes total sense. In terms of like the markets that you're seeing, is this sort of broad-based all around the US, or is this targeted to any locations? Like you did mention earlier that, if it's sort of funded by one institution or family office, kind of putting them in the institution bucket anyway, they've gotten so big, versus the more syndicated side, like were there more syndicated deals in locations that were kind of seeing this issue play out at, or is it kind of just broad-based across the US and, everyone sort of facing this problem?
Yeah, it's actually, I would say there's a huge concentration, and it's mostly, I would say, Georgia, Texas, Florida, some California, but mostly those three markets. And I would say Texas is probably number one. Georgia's is kind of like on par with Florida, but I would say those three are a mass majority of
And
of,
and,
of
and
this
why,
type of financing structure.
but
Yeah.
and why do you think that is?
I mean, I think that is because those were the areas where a lot of people moved out of the major metropolitans in New York City, the Los Angeles, all of those areas to an area where like, hey, you were paying $2,500 a month for rent. You could pay $1,500 here and get 3 times the space. I mean, I used to look at it all the time. I'm originally from LA. I live in New York City right now. For a fourth of what I'm paying, I can have a house. It's just crazy, and it's really interesting. And I think that naturally makes sense that the business plan would be, hey, we can put in back to that original point, 10K of renovation and get a $400 pop on rents because you have people that are coming from paying $1,600 more than you just offered them at a renovation scope. They're completely out of touch. But when you stop having that migration inwards and people start waking up and rates start going up and they need a jacket, not $400, but $1,000 just to keep up with debt payments, you start to see that kind of that slowdown.
Yeah, no, absolutely. That makes sense. And we're seeing deals from all over. Given the supply is lower in some of the other sort of non-traditional markets, we are looking at them. But Texas and Florida are where we have bought and sold almost 30 different assets, and so we know those markets really well. And every time you sort of buy and sell, you sort of have a little bit of an unfair data advantage because you're just used to seeing like the the rent pops and the vacancy and sort of how hard it is or how easy it is to kind of attract good quality tenants in those locations. And so, we definitely like to have a location niche and try to hone in on that. However, we've been seeing some great operators, great assets across the U.S. And it might be time to even start looking at those locations as even an purchasing kind of opportunity as well. As well as sort of through the fund, because we do multiple things at JT. Like we're sort of in the purchasing the single multifamily asset side, the fund side, and then also asset management. And so kind of bringing that trifecta to different areas and possibly partnering with other sponsors and owners, gives us a lot of different angles to look at in 2024. As I'm sure other operators are looking to kind of seize this opportunity. So definitely a very exciting time, that's for sure. Any other sort of investment or strategies that you guys are looking at that would be interesting for our investors and LPs to look at as well?
Yeah, I think one more point to bring up is I actually heard a few times this week, which is groups that essentially are tapped out on equity. The lender doesn't want to extend it, even if they can finance rate cap. And what they're saying is, hey, your loan is $10 million, pay it down 20%. So pay it down to $8 million. We'll reissue the loan, right? As a new credit, because we're comfortable with that leverage. What's interesting is, in theory, those are situations where the property is worth significantly less. And we're finding, potentially a group like JT that would come in and say, hey, we really like that basis. We'll pay down your loan that we're buying in at that basis, the loan balance. That was our equity buy-in. We're going to take over operations and do the deal. Instead of them handing back the keys, you essentially structure, and I'm seeing this happen quite a bit, we're going to take over the deal and we're entitled to a mass majority, call it 95%, 95% of the equity, because you essentially got wiped out completely and we're going to lose the keys. In the event that we absolutely kill it, we're going to try to make you whole for that original investment up to a certain point after we hit our net returns. What's interesting is you're getting 2021 built deals at $30,000, $40,000 less a door than they're selling for in the market right now, because that person doesn't have another choice. And they don't want to get and there's a difference between defined loss on equity, which is sell it today, take the haircut now, versus, hey, but maybe in 5 years things move back up. And I think those opportunities are really interesting if you're willing to keep the existing in kind of an LP position and take over as the operator, and you get some really institutional grade assets at, really rock bottom prices.
Yeah, well, my ears are ringing for sure, and I'm sure some of our other investors on the call as well. But this has been fantastic, Harrison. Where can people find you, and what are you looking for in your business? We're happy to sort of direct it your way.
Yeah, appreciate that. Anyone can look me up, harrison.drucker@greyco.com. Find me on LinkedIn. I, am primarily focused on, right now, the niche is, permanent debt, Fannie, Freddie, and HUD. Right now, the niche is really HUD. And if you have a bridge loan that, I guess conventionally is considered kind of over leveraged, and your sizing in Fannie and Freddie aren't really getting close, and you want someone to take a look and see how much they can push it and, kind of help work with you to get it to a point where it needs to be to get out neutral. That's kind of where I think I kind of shine, and that's what I do kind of day in, day out. So I'm happy to, chat on any deal. Feel free to give me a call, shoot me a text, and I'm happy to chat with you. But, goal is really to just try to make some of these deals work, because there's a lot to do that I think a lot of people aren't looking at currently.
Fantastic, Harrison. And yeah, I know I'm definitely looking forward to working with you a lot this year. Very exciting time in multifamily. So thank you so
100%.
much for your time, and have a great one.
Thanks for having me.